Hi, this is Mark with four tax ideas for you to consider today. Each of the four ideas require planning, and the illustrations in the examples show savings of anywhere between 6 to 8 figures. If any of these happen to apply to you, or if you're questioning whether or not they may or may not apply to you, feel free to reach out. We have plenty of material and experience on all four, and are glad to share that with you to see if we could help you make any of these work for you. Thanks. So here we are with our four best tax strategies as we film this in the early part of 2024. The first topic is that of more than your 401k. Most everybody's familiar with the 401k, what it can do, and how much you can contribute to it. But what our program came up with, it had an analogy of this, and that is you can see in the lower left-hand corner, there is a very small garden, and that symbolizes what you're allowed to contribute to a 401k, 20, 30, $50,000, depending on how you have it set up. And using this particular strategy, you don't have that one garden, you have almost six gardens, or in other words, 5 times that you can contribute to a standard 401k by using this strategy. So let's look at who the best candidates are for this strategy. As you can see, reading top to bottom here, typically they're companies with up to 5 employees, most importantly, just not an awful lot of employees, professionals, physicians, attorneys, consultants, partners, what have you, usually work well. They're looking for companies with high stable profits in order to fund this plan. And many times it's an older owner with younger employees. And importantly for that older owner, it's somebody who wants to contribute more and more to their plan because maybe they want to have a higher lifestyle once they retire, or they have not saved enough to maintain their lifestyle. So this is particularly attractive for them. High tax deductions, a minimum of a 3-year commitment is usually warranted. And let's get to a case study. Here we have Molly. She's 55 years old. She's the owner of a C Corp, 5 employees and 2 full-time employees. You can see on the top that Molly's earning $400,000 on her W-2. Her spouse earns funds, and then you'll see the 2 full-time employees as well. I'll direct your attention to the third blue bar moving down. You could see that by saving that $263,000, it's on the second bar, she's saving over $100,000 in taxes by using this plan. And importantly, you could see from age 55 in this projection to age 62, second blue bar from the bottom, she's going to be able to set aside almost $2 million in that period of time on a tax advantage basis, $1.78 million. So a real nice tool to have to complement your 401k if you fit that profile. The second tax idea that the AI came up with was for real estate investors who are in the unfortunate position of being unable to do anything with their real estate because it's so highly appreciated that they'll be taxed into the ground if they move it. The AI analogy was looking at this as though the available real estate to purchase were a pile of puzzle pieces out there, and you had to select which ones you wanted to purchase in order to grow your real estate portfolio. And here the finished puzzle symbolizes that your real estate portfolio. In this case, you have 1, 2, 3, 4, 5, 6, 7, at least 8 different properties, all put together very nicely, looking good for all of the hard work that you put in to acquire that portfolio. Unfortunately, you won't get all of that if you just outright sell those properties. You'll have about 3 or 4 of those properties once you get done paying taxes and other associated costs. So we want to try to avoid that. The best candidates here are somebody who's looking for a passive strategy, trying to avoid the terrible T's, tenants, trash, toilets, and termites, and maybe get a little bit better lifestyle. Also avoiding financial obstacles. 2 weeks ago, mortgage rate shot back up north of 7% in the span of 48 hours. So that's something to contend with. Investing in institutional grade properties, equal ownership to heirs where you could divide out in equal portions your real estate portfolio or the proceeds from that to your heirs. It's a great backup for transactions in case one of your transactions should fall through. This is always available if you follow the rules in order to make that transaction a reality. And of course, tax advantages that we'll look at right now. This is a hypothetical real property sale. Without getting into all the details, on the right-hand side, you'll see at the top line, it shows the sale proceeds are $1 million. $1 million is a good level to make some comparisons. Excuse me. And once you take out the cost and the taxes, the bottom line shown on the left-hand side in blue print is a little over $700,000. So we'll say in this scenario, the investor is losing 30% of his or her portfolio to various costs and taxes. This next slide shows what we can do through a 1031 exchange using this strategy that we mentioned earlier. And same procedure, start with $1 million, avoid the costs, avoid the taxes, and you come out with that $1 million from which you can use your investments to invest in new diversified portfolios. And finally, instead of the terrible T's, you'll have the terrific T's, which is you'll get to select between travel, time, and or tennis once you complete those transactions. The third tax strategy here is that of keeping your money. And the concept here is we've all paid insurance premiums to various providers for personal means or business means. And this is an idea of keeping the money in-house in order to create your own insurance company. The AI analogy was that of it symbolized your business as a strong sailing ship moving along the waves without any incident. However, we want to avoid an incident like this occurring to your business and not being prepared. So what AI suggested was we have not just our ship, but we add this auxiliary ship shown in the forefront here, so that depending on what type of catastrophe or disruption the business experiences, the business can always survive by using this rescue vehicle on the side, symbolizing your own insurance company. The option, or it's a great option for businesses that fall into these categories. You need to have revenues exceeding $4 or $5 million. Very simply put, the more revenue that you have, the more cost effective this strategy becomes. You also want to have a handle on your financial stability through your risk management. You want to be able to control your taxes or your overall earnings for the business itself. You also want to have a handle on your claims and your loss history, because this isn't something that's necessarily good for a business that is, say, farming out mercenaries to go fight in foreign wars, which an insurance company might not want to get involved with either. So you want to be able to have some history of your claims. And the way this works, just looking at this chart, on the left-hand side, we have what we'll call a market-based insurance plan for this business, and that's using a national or international carrier for your insurance. And on the right-hand side is creating your own insurance company, which we'll call a loss history insurance. In other words, you have a handle on your loss history. Moving through these numbers, top to bottom, these are numbers over a 10-year period. So it's $650,000 of net business income per year brings you to $6.5 million for net business income for both businesses, as you'll see in both columns here. The next line is uninsured claims. This is what the insurance is going to have to pick up. We'll consider that $130,000 per year, bring us to $1.3 million over the 10-year period. Now the differences start to pop in. Of course, if we're going to have our own insurance company, we're going to have operating expenses. And on the right-hand side, halfway down, at $75,000 a year, we come to $750,000 to operate our own insurance company over that 10-year period. The next line is the investment income. If we're sending a lot of our premiums to an insurance company, we have on the left-hand side $885,000 available for investment income. To the right-hand side of that, we have $1.35 million in investable income, because we're using our own money and reinvesting that rather than the insurance company doing that. The second to the last line is income tax. For the market-based insurance on the left, we have $2.5 million, and for the loss history insurance, $400,000, and bringing us to the final profit realized over that 10-year period, $3.5 million versus $5.3 million, or in other words, this is a $1.8 million cost advantage for somebody who fits the requirements in order to create their own insurance company. Rounding out our tax strategies, we have something that, as you see here, Uber, Slack, Lyft, and Pinterest all used this strategy when they were very small companies, not like they are today, publicly traded, et cetera. So we want to see if this is something available to you. The AI analogy for this came up with the idea of that of baking a cake. A cake is baked in layers, as we know, a bottom layer, a middle layer, and maybe a top layer, then icing added on and decoration. I see that AI came up with a candle in the background here, symbolizing a business recognizing its milestones. The trouble, again, like we saw with some of the other cases, is that if an owner or founder were to go out and outright sell the business or just transfer the assets, they're not going to get that whole cake. They're going to lose a portion of it, and probably more than they'd like. So we want to find a way to be able to keep those assets that you've worked so hard for as the owner or founder of a business and still be able to transition out of the business. Best candidates here, you need to be a C corporation. Many times an S corp will have to convert to a C corp in order to enjoy this treatment. And this can't be something where a large corporation comes in and starts playing games with tax laws to try to take advantage of. Can't be a corporate corporate stockholder, and it has to be done for cash, property, or services. The fourth bullet is a $50 million test, and we'll see how that comes into play, again, to avoid big entities from coming in and abusing this tax law. And then also here you see that it has to be held for at least 5 years. It's not, again, something you could snap your fingers and enjoy this tax treatment. The case study here is that for Beyond Meat. You'll see in the lower left-hand corner. We went through this already. You could see it qualifies as a C corporation. Upper left-hand corner, moving down, it had a qualifying industry. Final point on the left column is it has to do with when the stock was issued. Top right-hand side, you'll see that $50 million test that we'll get to in a minute, and some other criteria. So here's the timeline. This is publicly available, incidentally. You're welcome to look at this. But moving for Beyond Meat from 2011 through 2019, you could see that it moved year after year all the way up until this red circle in 2017. You'll see $55 million. So it no longer qualified for this tax treatment. It had to deal with between the years of 2011 to 2017, where it was able to take advantage of this. So in the final analysis, the results are extremely impressive. This should say 10 limited partners were involved in the sale of Beyond Meat. They used the exclusions that we've discussed for the sake of the transaction, a $100,000 investment that now had a $76 million gain, related to $18 million in tax savings, again, just by using this structure and strategy in order to transition the business. Some pretty significant tax savings. So hopefully some of that helped you. If you were aware of it, maybe you learned something else. If you weren't aware of it, maybe it's a new concept you might want to look into. We'll be providing more of these videos in more detail in the hopes that some of you can use some of them for your own personal and business benefit. Thanks.